Today, we are undertaking a critical assessment of Alcon Inc., ticker ALC.
Right.
And for you, the sophisticated investor, the focus isn't just on growth, it's on deep value creation.
Right.
And really rigorously scrutinizing every single decision made around capital allocation.
Exactly. And Alcon is at a fascinating inflection point right now. I mean, it's one of the most complex, high-stakes investment cases in the entire medical technology sector.
So we've synthesized a range of materials for this.
We're looking at strategic investment reports, the latest Q3 2025 financials, and some pretty detailed competitive threat assessments.
And all these sources define this central tension, right?
They do. It's this collision between Alcon's operational resilience, its very deep economic moat, and these significant external macroeconomic frictions.
Not to mention an aggressive and you could say potentially distracting M&A strategy.
A huge part of it.
Okay, let's just unpack that tension immediately. The core thesis that's supporting Alcon's current valuation is all about this transition.
It is. The idea that the company is moving on from that post-spin-off stabilization period, that kind of muted phase from 2019 to 2023.
And moving into a much more aggressive product cycle-driven growth phase.
And that entire transition is predicated on the success of one single platform launch, Unity VCS.
Everything hinges on it.
Absolutely. So the question for a truly critical investor is really twofold. First, does the quality and I'd say the velocity of this new Unity-driven growth actually justify the premium valuation the market is giving it?
And second, can management even execute this massive product cycle at the same time as this highly contentious, very high-stakes capital strategy?
Namely, that proposed Star Surgical acquisition we have to get into.
Yeah. But let's ground this in the recent performance first before we dive into the strategy. The Q3 2025 snapshot was, well, technically positive.
It was. Revenue hit $2.6 billion.
A solid 6% reported increase year over year.
And more importantly, for the near-term story, core diluted EPS came in at 79 cents.
Which beat consensus expectations by about 3.5%.
But while the beat was there, the market's reaction was, notably muted.
Right. That tells you caution is outweighing the enthusiasm.
And we see that caution reflected in management's own guidance. They slightly revised the full-year revenue, narrowing the range to between $10.3 and $10.4 billion.
But the real friction point, the thing that demands investor focus, is this looming margin erosion they're projecting for 2026.
And that erosion is specific. It's quantifiable.
We're talking about management explicitly saying that incremental tariffs alone are going to hit their cost of goods sold.
By up to $100 million in 2026.
That is not a minor headwind.
No, it's a structural cost increase that requires a very, very detailed mitigation strategy.
It demands some rigorous forward margin modeling from anyone looking at this.
It really does. The tension here is so high. They're introducing a super efficient, technically superior surgical platform, which should logically expand margins.
But those operational gains are being immediately canceled out, or at least offset, by these external geopolitical costs.
Let's start with the foundation of their defense, then, the core moat.
Okay. When we classify Alcon as having a wide economic moat, what we're really acknowledging is the degree of structural protection they have. It's rooted in two things: high surgical switching costs and intangible assets, the brand trust in the operating room.
But the key point now is that the durability of that moat is being aggressively tested by competitors.
The surgical division is really the engine of that moat, isn't it?
It is. Unlike consumer goods where brand loyalty can be fleeting, in a surgical environment, the switching costs are just astronomical.
And it's not just the cost of the new equipment.
Not at all. It involves revalidating the entire operating theater workflow, retraining a highly specialized surgical staff on new protocols, and, critically, accepting the perceived risk of adopting an unfamiliar system for something like cataract surgery.
That's a huge barrier. That structural inertia is the foundation.
And now Alcon is leveraging that inertia to launch the biggest catalyst in their recent history.
Something designed to lock in cash flows for the next decade.
The Unity VCS platform shift. This is the new razor that starts the whole supercycle.
So the Unity Vitreoretinal Cataract System, or VCS, and the Unity Cataract System, CS.
Right. They launched in late 2025, and this represents a fundamental strategic shift. This isn't just a refresh of the old Centurion or Constellation systems.
No, this is their mechanism for securing that high-margin consumable pull-through.
The blade.
For the machine's full 7 to 10-year life cycle.
Exactly.
But the core selling point has to be profitability, right? For the hospital administrator focused on the bottom line, Where's the quantitative evidence that Unity delivers an efficiency moat?
The sources have some powerful early data on this. Time and motion studies are showing efficiency gains that directly translate into revenue maximization for the provider.
Okay, like what?
Specifically, we're seeing up to a 16% efficiency improvement in complex vitreoretinal workflows.
16% is huge.
It's massive. And for the higher volume cataract surgery, the reported gain is a 6% reduction in operating room turnover time compared to their previous generation.
Okay, let's just break down what that 6% turnover reduction actually means.
Yeah.
In a high-volume setting, say in the U.S. or one of the high-growth Asian markets,
All right.
if a surgeon is doing 10 cataract procedures a day, a 6% gain means they can consistently squeeze in an 11th, maybe even a 12th surgery,
Without increasing the length of the workday or hiring new staff.
which translates directly into massive incremental profitability for the provider.
It makes the capital expenditure on Unity almost self-financing over time.
It creates that compelling financial justification that just overrides the upfront sticker price.
Precisely. But for the clinical side, the tech superiority is just as important. Unity introduces advancements like 4D FICO technology and its redesigned intelligent fluidics.
We can't just name drop these features, though. For the sophisticated investor, we need to understand the mechanics. How does intelligent fluidics translate into reduced operational risk?
This is where the technical nuance really matters. Intelligent fluidics is designed to virtually eliminate something called post-occlusion surge. It's that sudden, brief drop in intraocular pressure, or IOP, when the phaco needle clears a piece of lens material. That surge can increase trauma to delicate ocular structures.
Okay.
Unity system uses advanced pressure sensors and active vacuum management to maintain near physiologic IOP throughout the entire procedure.
So, greater stability.
Greater pressure stability, which reduces surgical trauma, accelerates patient recovery, and minimizes complications. That's the ultimate justification for the surgeon.
So it's a dual-pronged pitch.
Yeah.
More revenue per day for the administrator and reduced risk and better outcomes for the surgeon.
Exactly.
Now let's talk about the true genius of the lock-in,
Yeah.
this walled garden effect.
This is Alcon's play for B2B stickiness. I mean, it's comparable to the integration we see in the Apple ecosystem, but applied to the operating theater.
So Unity is the central hub.
It's the central hub linking directly to Alcon's proprietary diagnostic devices, specifically the Argos biometer for measuring the eye and the smart cataract planning software.
So it's not a standalone machine. It's an integrated digital operating system.
Correct. And this proprietary integration creates a seamless data loop. From pre-op measurement to planning to real-time surgical execution and then post-op data capture.
And once a clinic has standardized its entire process on this integrated workflow,
Using proprietary data formats and software interfaces,
the operational friction of trying to switch just one component, say the console, to a competitor like Zeiss
becomes financially and logistically prohibitive. They are locked into the Alcon digital infrastructure.
That high degree of integration explains their confidence in that annuity stream.
And we are already seeing the leading indicator for this success in the Q3 results.
You're talking about the equipment other subsegment.
Yes, it saw a powerful 13% surge in Q3 2025. This entire surge is attributed to the initial global rollout and placement of the Unity VCS platform.
So that's capital expenditure today.
That translates into guaranteed high-margin, recurring consumable revenue tomorrow, locked in for 7 to 10 years.
Okay, moving from the razor to the blades, the high-motion consumables. Alcon's market leadership in premium IOLs is foundational to their margin structure.
They're the undisputed global hegemon in presbyopia-correcting IOLs, or PCIOLs. They command over 60% global share.
And this market is crucial because patients often pay out of pocket, right?
Yes, big premiums for these advanced trifocal and EDO lenses. That provides a protective layer against government and insurer reimbursement pressure.
And their 2025 launch of PanOptix Pro was a direct defensive move.
It was a necessary one. The PanOptix Pro, which features their proprietary Enlighten NXT optical technology, was explicitly engineered to defend market share against Johnson & Johnson's aggressive push with the Tecnis Odyssey.
The critique against the older trifocals was always about visual disturbances, halos, and such.
Right, a major patient complaint.
So how does this new technology mitigate that?
Enlighten NXT focuses on optimizing energy distribution and improving light utilization efficiency to an extraordinary 94%.
94%.
By refining the diffractive optics, they significantly reduce that visual noise, which enhances contrast and reduces the severity of those halos.
And it strengthens their premium position against J&J.
It does. And finally, you have the strategic role of Vivity. It seems niche, but it acts as a critical segment defender.
How so?
Vivity is their non-diffractive extended depth of focus lens, or EDF. It's crucial for market segmentation. Because of its design, it has an extremely low visual disturbance profile,
Making it the ideal choice for
the large cohort of patients who are medically ineligible for trifocals. Think of people with mild macular degeneration or corneal irregularities.
Right, so without Vivity, those patients would just get standard lower margin lenses.
Exactly. Vivity ensures they remain in the premium high-margin revenue stream.
Okay, so Section 1 confirms Alcon is executing a highly sophisticated strategy to widen its moat. But that aggressive strategy is financially taxing.
Which brings us to the margin tug-of-war. The Unity narrative promises future profits, but the astute investor has to prioritize the present reality of the P&L.
And we are seeing intense pressure on profitability in Q3 2025.
Intense, due to a combination of internal and external forces.
And the evidence of compression is stark. Core gross margin contracted 50 basis points year over year to 62.9%.
And core operating margin contracted 60 BPs to 20.2%.
For a company celebrated for its premium pricing, this compression directly contradicts that high-quality franchise narrative.
Let's isolate the external friction first. The primary culprit is the geopolitical trade environment. Tariffs and foreign exchange volatility are just biting into KGS.
In that $100 million projected tariff hit to KGS in 2026 is the biggest red flag. This requires more than just hoping for operational efficiencies. What levers can they actually pull to mitigate this?
The mitigation strategy seems multifaceted. First, they're implementing tactical price increases on key consumables and the Unity consoles.
Banking on the workflow efficiency gains to justify the higher price.
Right. Second, the sources indicate an accelerated program for supply chain diversification.
Shifting sourcing away from high tariff regions.
Specifically China, moving into lower-cost, trade-friendly places like Mexico, Vietnam, maybe even new hubs in India. But shifting a complex supply chain takes time and incurs its own near-term costs.
So we're absorbing two sets of costs simultaneously, the tariff hit itself and the cost of restructuring the supply chain to escape future tariffs.
Which confirms that 2026 will be a heavy lift for margins.
When the internal investment headwinds only compound this.
Absolutely. The operating margin contraction is directly driven by the elevated spend required to execute this product supercycle. Sales and marketing expenses are way up to support the global sales teams needed for Unity.
And for commercializing the new assets like PanOptix Pro and the dry eye treatment, Triptyr.
And R&D remains a premium commitment, approaching 10% of sales. They are investing heavily. It's necessary for long-term moat defense, but it's a guaranteed short-term earnings suppressor.
Okay, now we have to turn to the most critical metric for evaluating capital allocation. Return on invested capital, or ROIC.
The ultimate test of value creation.
Let's scrutinize that spread. Alcon's ROIC on a trailing 12-month basis is about 7.35%.
And their weighted average cost of capital, their WACC, is relatively modest at 4.15%.
So the spread is positive. They are technically creating value.
For a premium multiple stock trading at 37 times trailing earnings, a 7.35% ROIC is, frankly, mediocre. We should be challenging management on this thin spread.
I agree. When we benchmark this against highly efficient peers like Cooper companies, you see much higher cash-on-cash returns. Why is Alcon's metric so suppressed?
It's primarily a function of two things. One, the high capital intensity of the surgical equipment business, which depresses asset turnover.
Right.
But equally important is the balance sheet. The ROIC denominator is inflated by massive intangible assets and goodwill from the Novartis spinoff in 2019. It carries a legacy burden.
So the task for management is clear. They have to expand that ROIC spread.
Yeah.
The entire investment thesis rests on the belief that the installed base of Unity systems will accelerate asset turnover so rapidly that those consumable cash flows finally start to overcome the suppressed metric.
If that Unity ramp is gradual, the multiple is precarious. It's the core financial monitoring task for 2026.
Okay, let's pivot to the most significant external structural risk,
Yeah.
the China factor. specifically volume-based procurement, or VBP.
VBP is the Chinese government's mechanism to just slash healthcare costs by forcing manufacturers into hyper-aggressive bidding wars for guaranteed volume.
And the results are brutal. Price cuts often exceeding 80%.
And VBP is not a theoretical threat, it's an established reality. It has already expanded to include intraocular lenses, resulting in price cuts of 60% to 90% for standard monofocal bids.
This action basically bifurcates the Chinese market
Into a public low-margin segment and a private premium segment.
And Alcon's defense has been to largely ignore the public tender system, focusing on the insulated premium private hospitals.
Right, so their direct exposure to VBP is currently marginal, estimated at only 1 to 2% of total sales.
That strategy is working for now,
Yeah.
but the investor has to look ahead. The latent risk, the profitability cliff, is the potential expansion of VBP into high-value products.
We've seen it happen before. VBP moved into orthopedic joint replacements, which were considered complex and high value.
So the concern is that in 2026 or 2027, Beijing could decide to expand VBP to include premium IOLs or core surgical consumables.
Exactly. If the Chinese government mandates VBP for trifocals or EDOF lenses, it would decimate Alcon's regional margins overnight. They're walking a tightrope. The execution risk is systemic.
Okay, if the first two sections highlighted the operational tensions, this next section defines Alcon's new, aggressive, and highly scrutinized strategic posture.
The pivot to acquire and conquer.
And this is most clearly evidenced by the contested acquisition of Star Surgical.
This $1.6 billion deal is the definitive signal of management's willingness to deploy significant capital to secure market dominance. It communicates a shift from purely organic development to an inorganic leveraged approach.
What makes Star and its EVO ICL lens family so strategically vital that Alcon is willing to pay such a high premium?
The goal is to capture the high-growth phakic IOL market. Star's EVO ICL is the clear market leader.
And this is a different demographic than their core cataract business.
Completely. It targets a younger demographic, patients under 45 with severe myopia who aren't ideal candidates for LASIK. Acquiring Star instantly catapults Alcon into a near-monopoly position in this specific high-potential segment.
So the strategic rationale is simple. By growth and dominance in a segment they couldn't generate organically.
But the drama is all about the price and the resistance.
The price is extraordinary.
It is. It signals urgency. Alcon raised its all-cash offer to $30.75 per share, valuing Star at roughly $1.6 billion.
That is a massive 74% premium to Star's 90-day volume-weighted average price.
It's an aggressive take-it-or-leave-it offer.
Yet it's facing fierce resistance.
It is. The resistance is being led by Broadwood Partners, a big institutional investor holding about 30% of Star.
And their argument?
Their counter-thesis is that Alcon is severely undervaluing a true disruptive platform. They argue that based on market expansion, especially in Asia, the intrinsic value is closer to $50 per share.
Which makes Alcon's offer unacceptable to them.
And this opposition introduces immense execution risk.
Especially when you consider the operational timeline.
Precisely. The core sources indicate the shareholder vote had to be adjourned to January 6, 2026, because Alcon likely did not have the votes.
Which means management is engaged in a distracting, high-stakes proxy battle during the single most critical product launch window for Unity VCS.
Management focus is a finite resource. This battle risks diluting attention away from the surgical supercycle.
And the implication of failure or success here is huge.
If the deal fails, Alcon is left with $1.6 billion in excess cash and has to quickly articulate a new, credible deployment strategy.
And if it succeeds?
While it guarantees refractive dominance, the high premium paid translates into massive goodwill on the balance sheet, which will almost certainly dilute that already thin 7.35% ROIC in the short term.
So you have to tolerate short-term pain for long-term gain.
Let's look at a precedent. The 2022 Aerie acquisition for $770 million was also a high-stakes move.
Can we assess their M&A track record through that lens?
The Aerie deal was aimed at expanding their ocular health portfolio. Its success really hinges on the acquired pipeline product, Triptyr, for dry eye disease.
And the ROI is determined by its ability to capture market share.
Right. Ocular health grew 7% in Q3 2025, which suggests the acquired assets are contributing.
But is that enough to justify the premium?
The 7% growth is good, but the dry eye market is dominated by multi-billion-dollar franchises like Restasis. To justify the cost, Triptyr needs to realistically target a peak market share of 10% to 15% in the U.S. over the next 5 years.
If it struggles, the Aerie deal gets reclassified as marginal value creation.
And that raises concerns about their M&A due diligence, right as they're trying to close the much larger Star deal.
So the whole growth narrative is now heavily reliant on successfully integrating and commercializing acquired assets. It's just layers of complexity on top of the organic Unity supercycle.
It is. And it's easy to get tunnel vision on Alcon's internal strategy, but the surrounding market is an arms race.
Right. The ophthalmic sector has powerful demographic tailwinds.
An aging global population guarantees rising cataracts and glaucoma, so you have a structural market growth rate of 4% to 6%.
Which guarantees competitors are spending heavily to break Alcon's dominance.
Let's start with Carl Zeiss Meditech, or CZM. They represent the most critical direct challenge to Alcon's surgical ecosystem moat.
What did they do?
Zeiss fundamentally changed the dynamic by acquiring the Dutch Ophthalmic Research Center, DORC.
Okay.
This move immediately allowed Zeiss to offer the EVA NX US platform, which directly closes the technology gap in the complex vitreoretinal surgery segment, an area Alcon historically monopolized.
So they're aggressively replicating Alcon's exact ecosystem strategy.
Precisely. They're trying to build their own walled garden by bundling EVA and Nexus with their high-precision diagnostics like the IOL Master 700.
And the sources highlight that the EVA NX US platform has a unique dual-pump fluidics system.
That's a direct technological challenge to Alcon's intelligent fluidics. It claims to offer superior laminar flow, minimizing turbulence and providing exceptional stability.
So if Zeiss can credibly demonstrate equivalent or superior control,
they are perfectly positioned to capture market share if the Unity launch encounters any stumbles. The battle for the surgical suite is now a head-to-head ecosystem war.
Okay, this leads us to the challenge from Johnson & Johnson Vision.
J&J is aggressively challenging Alcon's long-standing dominance in the refractive space through its WaveLight platform.
And their key threat is?
The Elita femtosecond laser system, which uses a next-gen procedure called Silk Smooth Incision Lenticule Keratomileusis.
Why is Silk a paradigm shift?
Because refractive surgery is shifting toward lenticule extraction, moving past traditional LASIK. Clinical data for Silk suggests faster visual recovery, reduced corneal impact, and superior structural integrity because it avoids creating that large corneal flap,
which was the central complication risk of LASIK.
And this advance leapfrogs J&J ahead of earlier technologies.
That makes the connection to the Star acquisition perfectly clear.
It does.
J&J's innovation created a material product gap for Alcon. If they can't innovate internally to match Silk, they have to aggressively buy dominance in an adjacent segment.
Like phakic IOLs. That is the essential insight. The $1.6 billion premium for Star isn't just a strategic gamble. It's an urgent, competitive reaction to J&J's successful technological disruption.
It's necessity driven by competitive pressure.
Exactly.
Finally, let's quickly touch on the resilience of Alcon's vision care segment. The moat is narrower here, but it provides that annuity-like stability.
It does. The moat there relies more on IP and material science and brand equity. The proprietary water gradient tech in lenses like Dailies Total One and Precision One creates a key differentiator in comfort.
And this supports their pricing power.
Critically, yes. Alcon successfully executed volume-neutral price increases in both 2024 and 2025. That's clear evidence their tech differentiation allows them to pass costs to the consumer without significant churn.
A highly valued quality in a defensive compounder.
So we've established Alcon is a high-quality franchise caught between this extraordinary opportunity with Unity and immense friction.
Right. Tariffs, ROIC compression, competitive intensity. Let's synthesize this into actionable takeaways. We define Alcon as a defensive compounder.
The defensiveness comes from the revenue predictability. The vast majority is annuity-like, the recurring consumables from the surgical model, plus the stable revenue from the daily vision care lenses.
And that stability translates directly into cash flow strength.
Alcon is a cash cow. They generated $1.2 billion in free cash flow in the first 9 months of 2025. This is what funds the share repurchase program, $384 million repurchased year to date, and gives them the firepower for M&A like Star.
They have the capability. But now the critical check. Valuation. Alcon trades at a premium multiple. roughly 37 times trailing PE, which compresses to about 24 times forward PE. This implies the market is already pricing in a very aggressive earnings acceleration.
It leaves virtually no margin for error. The premium is only defensible if Alcon proves it can execute the unity cycle flawlessly and, crucially, expand core operating margins toward that 25% threshold.
And they're sitting around 20.2% right now.
So that expansion is masked. Until the tariff costs subside and the R&D and S&M investments normalize, that expansion gets pushed out to 2027 or 2028. If they can't hit that 25% target, the multiple contracts sharply.
Okay, let's define the investor checklist for 2026. What are the 3 things you must monitor above all others?
First, the velocity of Unity VCS installed base. We have to see that 13% equipment growth rate accelerate or at least be sustained through 2026. If placement is slow, the whole supercycle thesis fails.
Second, the STAIR shareholder vote.
The outcome on January 6th is binary. If it closes, the focus shifts to integration and ROIC impact. If it fails, management must immediately articulate a new capital deployment strategy.
A failure risks signaling distraction and a lack of discipline.
And third, tariff impact mitigation and gross margin defense. Can Alcon navigate the guided $100 million COGS and still keep gross margins above that 63% threshold? This is the test of their pricing power.
Okay, let's conclude with potential scenarios based on those monitorable.
The bull case, let's say $105 plus valuation, requires near-perfect execution. Unity drives a massive replacement cycle, pushing surgical growth beyond 7%.
STAIR closes smoothly and adds to the growth.
And crucially, margins expand quickly to 22% or higher as launch costs subside, and pricing power mitigates the tariffs.
The base case, maybe $85 to $95, sees growth remain in that structural 5–6% range.
The Unity ramp is successful but gradual, maybe delayed by technical challenges or aggressive marketing from Zeiss.
The STAIR deal faces delays or requires a costly modification.
And margins stay flat, around 20%, as the tariffs offset any internal efficiencies.
And the bear case, below $70.
This involves failure on multiple fronts. The Unity launch stalls. China VBP expands aggressively into premium IOLs.
And the STAIR deal collapses entirely, leaving management distracted and the capital allocation directionless.
This scenario invalidates the premium multiple entirely.
So Alcon is structurally sound, operating in a favorable market, but it's at a high-stakes juncture. The long-term narrative hinges almost entirely on whether the Unity VCS supercycle can generate enough velocity to overcome the immediate frictional costs.
And the intensifying, sophisticated competitive threats from Zeiss and J&J. 2026 is structurally a heavy transition year. The investor has to accept the costs are being absorbed now, and the full financial benefits will only materialize later.
Patience must be balanced with extreme vigilance. So here's our final provocative thought for you to mull over as you assess the risks.
Okay.
We've established Alcon is paying a massive 74% premium for STAIR Surgical, an aggressive all-cash bid happening during their core product supercycle launch.
So the central strategic debate is whether that $1.6 billion expenditure represents a bold act of monopolistic conviction, a willingness to crush competitors and buy dominance.
Or if it's a sign of underlying strategic necessity. A panicked attempt to buy growth in a refractive segment where their organic innovation has demonstrably lagged behind rivals like J&J's Silke.
What does that particular capital allocation decision tell you about their confidence in achieving future organic growth versus their need to rely on inorganic growth?
This decision defines the company's capital discipline for the next decade.
A question that should frame your long-term assessment of Alcon's leadership. Thank you for joining us for this deep dive.
We'll catch you next time.